Now, who's got the latest business news?
Thank you very much, Ramah. Here's what's coming up on BizAfrica tonight. South Africa's main auto union threatens to strike at a Volkswagen factory. And Zimbabwe will require all of its banks to list at its stock exchange. South Africa's main auto union has threatened to halt production at a Volkswagen factory in the country to protest against the dismissal of some of its members. The National Union of Metal Workers of South Africa said it had called on the managers at Volkswagen South Africa to immediately stop the dismissal of its workers, or it would be forced to halt production until this deadlock has been resolved. Now, early in the week, workers at the Mercedes South Africa assembly plant downed their tools, also demanding pay hikes. Now, it's feared that the latest wave of labour unrest in the country could spread to other sectors ahead of mid-year pay negotiations having started at the platinum and chrome mining companies. Still in South Africa, union leaders say they will not accept a job cut planned by Anglo-American Platinum, and they have vowed to fight the decision. Mediation began on Friday between all the main stakeholders. Originally, this was designed to manage 6,000 retrenchments announced by the company last week. But it looks as though the dispute could drag on. With the details, here's CCTV's Guy Henderson.
With Rustenburg relatively calm for now, the front line has moved to the boardrooms of central Johannesburg. Decisions made here in the weeks ahead will either soften the blow or fan the flames. What Anglo does, others will emulate. So what happens now? In a statement, the company said it had agreed on measures and mitigation plans that will preserve jobs with the Department of Mineral Resources, and that would now serve as a basis for meaningful consultation with employees and their representative structures. So far, engagement appears to have had some impact. Despite continued threats, no repeat yet of last year's wildcat strikes. Though they have popped up sporadically elsewhere, at Lonmin last week and at a chrome mine nearby, a sector until now unaffected. For unions though, even one job loss is too many. Though the platinum miners' now principal representative won't talk, the minority NUM says it will fight on.
We agree that they need to get their finances in order, but they can't get their finances in order by retrenching people. That can't be the route. We're saying if it is true as it appears that they have chewed, they have swallowed more than they can actually chew, they must offload some of their assets and put those licenses on public auction.
More delays, say analysts, could be more costly to everyone in the long run.
I mean, the longer it takes, it's firstly from a market perspective, it's additional metal you put on the market, which is not helping the current fundamentals for the market. Ultimately, you can't go on like this forever. There's got to be some sort of solution where you could say we agree to settle on the following outcome, and we'll, from a company's perspective, they will try and limit the impact of such a decision.
And Anglo could be just the start. So at the end of all this, 6,000 jobs will go. The only questions now are around who, and perhaps more importantly, how. So there's likely to be discussions around skills training for those who are going to be laid off, and also options for a decent severance package. But will AMCU accept any of those conditions? And even if they do, will the workers themselves listen? Guy Henderson, CCTV, Johannesburg.
Now, Guy Henderson, of course, has been keeping tabs on the evolving story about the labour strike and the ripple effects on South Africa's economy over the last couple of weeks. He joins us now live from Johannesburg with the latest developments. Guy, with respect to Amplats and its planned job cuts, what's the latest development on that story?
Well, they haven't actually started retrenching those workers yet, basically. This whole process dates back many, many months, way before even these wildcat strikes that started throughout last winter and into the spring. Initially what happened is the company, Anglo-American Platinum, commissioned a report to look into ways of restructuring their business, in part given the fact that platinum prices were beginning to come down after that boom of a few years before. So they commissioned this report. Then while that report was being done, these wildcat strikes broke out, production was disrupted, a lot of pressure put on the company. Then in January 2013, the results of those reports came out, and the company then recommended or announced that 14,000 jobs would have to go from Anglo American Platinum's operations in order to try and balance the company's balance sheets, to try and get them out of the red. Now, the government basically turned around in January and said, no, you don't, at which time Amplats then had to go back into negotiations with the Department of Mineral Resources and the Department of Labour. Where the stage we're at now is that they came out of those talks and announced a revised plan of 6,000 job cuts 2 weeks ago. And what started today, on Friday, was a process of mediation whereby the company was meant to take that job cut proposal to the unions and try not to debate their very essence, but try and mitigate the impact of those job cuts. But what it looks like is happening in the early stages of this mediation is that the unions are going right back to the beginning and saying to the company, not even one job loss is satisfactory or acceptable to them. So in terms of retrenchments taking place, well, that process hasn't started, and this is an open-ended process, so it could carry on for weeks or even months before retrenchments and restructuring even begin.
Indeed. Let's talk about something that President Duma said on Thursday. He essentially criticized the union, saying, and I quote here, they should not, the right to demand, rather, for better pay should not wreck the economy at the same time. It's all very well and good to say this, but what's the follow-up action following those comments?
Well, government's approach, at least at the beginning of when this labour unrest began last year, was fairly hands-off. Their view was that this was essentially a labour dispute and that essentially it had to be sorted out between employees and unions and employers. I think since then they've come to realise that it is a lot more than that. Firstly, of course, it's a law and order issue. That inter-union rivalry, that war really that's going on underneath the surface in Rustenburg, has left some of the areas slightly lawless as a result. It's also a case of saving face for the ruling ANC, really. The NUM admitted to me today that it's lost 34,000 of its members to AMCU since these strikes happened last year. Now, the NUM is allied with COSATU, which is part of this tripartite ruling alliance with the ANC. So if the NUM's losing votes, then in all likelihood, or support, then in all likelihood the ANC is as well. And as you say, of course, the third thing, it's having an impact on the wider economy. The rand is recently dipped to 4-year lows against the US dollar. And remember that more than 50% of South Africa's exports are metals. So it does have a very wide economic impact. In terms of what government is doing, well, it's apparently going to send a delegation of ministers to the region on a fact-finding mission, which is something it did last year as well. But its argument really is that in the short term, there's not much it can do. And while it can speak out and while it can implement government policy to try and implement some long-term plans to address some of the underlying issues of inequality and that kind of thing in South Africa, in the short term, there's really not that much it thinks it can do.
Indeed. We'll have to leave it there for the time being. Thank you very much for that insight. That's CCTV's Guy Henderson, who was live in Johannesburg tonight talking about the ripple effect of the labour strife in South Africa. The South African rand, of course, down about 6%, give or take a few on either side so far in the month of May. Disastrous indeed. Let's move on to Ghana now. The cabinet in that country has approved a Eurobond issue of up to $1 billion, tentatively scheduled for July. That's according to the country's finance minister, Seth Thakper, who also named the Accra-based Ecobank Development Corporation and Strategic African Securities as the bond's co-managers. Proceeds from the issue will be used for capital expenditure and refinancing public debt to cut borrowing costs. The minister said the government is considering additional measures, including tax hikes and regular adjustments in utility prices to boost tax revenue for the year after provisional data showed quite a few shortfalls in first quarter revenue targets. Also in Zimbabwe, fiscal authorities are exploring plans to have all banks in the country listed on the local stock exchange. Now, the move is expected to improve stability in the financial sector, which has witnessed a number of bank failures in recent years. It's not yet clear exactly when, however, this plan will be implemented. Players in the equity market, for their part, say it would boost activity, but it might be difficult to implement.
With 8 of the country's 16 commercial banks already trading on the local bourse, the push seems an achievable one. The finance minister is seeking a long-term solution to stability woes that have bedeviled the banking sector. No less than 3 banks have gone into liquidation over the past 2 years. The minister's comments are still being digested by the market.
The Bankers Association of Zimbabwe says it may be premature to comment on the plans, saying they have yet to be consulted and have only seen the reports in the media. They do say, however, listing on the stock exchange could inject much-needed capital into the banking sector.
The sector has been grappling with a liquidity crisis which has crippled banks' capacity to fund economic activity. Going to the market is one way of injecting funds into banks, although it is unclear if there would be enough appetite for the stocks.
Bear in mind that there's a lot of banks already listed on the market. So investors have a fair amount of exposure, I think, to banking assets.
The proposed plan could, however, help ease another headache.
Where I think it might add weight is on the issue of indigenization, where we're looking at what better way to parcel out or to localize or to invite local players or owners into foreign-owned banks.
Indigenization laws require all foreign-owned companies to cede 51% stakes to locals. The banking sector has been under the spotlight for failure to comply, and this could be a way out. However, valuation could be a potential stumbling block. Liquidity shortages and slowing economic performance have seen most stocks trade at discounted values, which could make the option of selling up stakes via the bourse unattractive. Farai Mwakutuya, CCTV, Harare, Zimbabwe.
Let's get a little more analysis into this. CCTV's Melanie Ralph is live in London tonight. You're going to pick up on one specific thread of that conversation: indigenization and its effect on Zimbabwean banks. Melanie, isn't this after the controversial manner in which Zimplat complied with the indigenization law earlier this year? Isn't the transparency and credibility of that indigenization process a concern for London-listed banks that have operations in Zimbabwe?
Yeah, absolutely, Ramah, and that's why Zimbabwe may suffer some resistance to this bank listing push. Actually, calling for a bank to list in the country it's operating in isn't an unusual request, but some analysts say that certain banks would be reluctant to hold their capital in Zimbabwe and face the possibility of handing over majority stakes to locals. That being said, it's not an uncommon desire for governments to make sure there's enough capital for that bank to sustain itself. The fear governments have is if the headquarter branch is listed outside their remit in a different country, then if the bank did fall on troubled times, the public could be facing losses. It's not clear why only banks are being targeted and not other companies in other sectors. Some analysts are speculating that it could be something to do with the Absa Barclay ties that's listed in South Africa, the multi-billion-dollar deal that Zimbabwe was left out of.
Indeed. Zimbabwe Central Bank Governor has also proposed a more gradual redistribution and ownership model to be implemented. Is that something that banks on your end are more likely to support?
Yeah, absolutely, Ramah. Implementing a listing on an index is a complicated process for a bank with several branches and authorities to consider. The accounting process becomes very complex. Some reports suggest, as indeed your report we've just had, that there are also issues surrounding company valuations for listings that needs to be ironed out in Zimbabwe if banks decide to do this. If a bank decides not to fall in line with Zimbabwe's request, it's then up to the regulator to decide how much the banking system would be at risk if they forced a bank out. And some of the foreign banks provide a substantial market share in the sector in Zimbabwe. The central bank chief also highlighted they provide a meaningful line of international credit too. So there could be a lot at stake here if Zimbabwe doesn't deal with this right.
Indeed, it's quite the juggling act. So we'll have to leave it there for the time being, though. That's Melanie Ralph live in London for us tonight, talking about Zimbabwe's drive to have most of its banks locally owned and, of course, listed compulsorily at that on its stock exchange. We're taking a short break here on Africa Live. Here's what's coming up next. The Johannesburg Stock Exchange is mulling over the possibility of joint ventures in commodity markets across the continent. We'll have the details on that when we return.
Africa, an amazing world, is coming closer to us. A new voice.
We have made an excellent beginning.
A new view. Let's watch together. We deliver news and views. Let's explore together. We get you inside real Africa. Every day, only on CCTV News.
Welcome back. It's 17:45 GMT. You're watching BizAfrica. Stock exchanges across the continent are starting to spread their wings and raise their product offerings to attract new investors. CCTV's Angelo Coppola caught up with two key players in the capital markets, and he filed this story about potential joint ventures to increase commodities exchanges and boost food security at the same time across Africa.
Soft commodities have been traded on stock exchanges for centuries. What we are starting to see now is the creation of commodity exchanges. The idea is to improve food security through more transparent pricing and linking of supply with demand. It's a logical progression as sections of Africa are increasingly seen as the world's breadbasket. South Africa has a commodities product at the JSE, and Rwanda is fairly close to getting a commodities exchange off the ground. Meanwhile, there are other developments.
We are working very closely with the Nigerian Stock Exchange. We are looking to put a commodity exchange in Nigeria, and we're both working on a NASDAQ platform. So we think that there is a lot of synergy there that we can work together to build that capital market. We also are working very closely with the South Africa Futures Exchange, its past managing director and its current managing director.
The JSE is considered to be a fairly entrepreneurial exchange. Under its previous CEO, plans to get involved in joint ventures on the continent met with limited success. This was partially due to the lack of deal flow in many of those other exchanges. This seems set to change as the JSE explores a new initiative with the Zambia Exchange.
A collaboration between us and the Zambian Agricultural Commodities Exchange in listing a derivative on the Zambian contract in South Africa traded in US dollars, which will enable Zambian clients and international clients to manage their Zambian commodity price risk. So I think it's a really innovative solution. It shows how if you use the expertise of the respective exchanges, they'll trade the spot, we trade the derivatives, you can actually offer everything to the clients.
As with any innovation, there will be several firsts, something that Newton King isn't afraid of.
A test case for a number of things. Firstly, I think it's a really good example of bringing to scale quite quickly. It's a test case for trading in dollars in South Africa. It's a test case for lots of interesting things.
Continental collaboration in the stock exchange space is fraught with complexities. These range from exchange rate issues, in-country financial regulations, and legal interpretation. Despite these challenges, it appears that the continent is set to see some exciting joint ventures, and farms of all sizes will benefit. I'm Angelo Coppola for CCTV in Johannesburg.
Let's wrap up the business segment with a look at the planet as a whole. The United Nations says global economic growth will continue to be below potential this year, saying that job creation will be critical to spurring a recovery. The UN World Economic Situation and Prospects 2013 Mid-Year Update notes that since late 2012, new policy initiatives in major developed economies have reduced systemic risks and helped stabilize consumer, business and investor confidence. But that in turn has had very little improvement in economic growth. Macroeconomic factors like world gross product, or the combined gross national product of all the countries in the world, now is projected at 2.3% growth in 2013. It is, however, likely to gather steam and gradually strengthen to 3.1% in 2014, supported by an expected pickup in the world's biggest economy, that's the United States.
Lingering synchronized global slowdown has been replaced by measurable improvements. US growth gained momentum and Japan grew by 3.5% in first quarter of 2013. In the euro area, there is contraction, but there is differences in divergence in growth there. Emerging economies are growing at below potential, but good growth rates.
The lack of accountability indeed at the root cause of the global financial crisis, which in turn caused this global, this great recession in the real economy. So if we need to deal with the weakness in the world economy, we have to deal with these root causes, that's for sure. And so far, of course, we have seen some progress, but very slowly in reforming the financial sector, in that both international level as well as national level. But the progress so far has been very slow because of some resistance from the financial sector.
Speaking of global momentum, let's see what markets had it and which ones didn't. This first you're about to see, however, had quite a bit of it. The all-share index in Nigeria ending the day in the green, up 2.41 percentage points. Over in South Africa, the all-share index relatively muted, however, posting relatively smaller losses compared to what it had yesterday. That was, of course, in a whole different order of magnitude. The 20-share index here in the Kenyan capital, Nairobi, in the green, but only marginally so, up 0.2%. And the Egyptian market, of course, was closed. 17:50 GMT. We've been watching BizAfrica. Thank you for watching right now, though. For us back with the sport.